All right, welcome everyone to our quarterly webinar. Uh, we obviously have had a very eventful period leading into this. Um, Sort of the fireworks started off, if you will, on April 2nd when there were reciprocal tariffs announced that were much higher than generally expected. It created a very strong negative market response that was, felt around the world. A week later, by the 9th of April, there was a 90-day pause announced that basically just the base 10% tariffs would continue, and uh, each country would negotiate with us on their individual tariff regimes and other trade practices. This quick backtrack was caused by two main events. There was a surprising rise in treasuries, and there was also a further weakening of the dollar. So 1/3 of U.S. treasuries are foreign owned. When there's panics in the market, there's a flight to safety, and normally that means a flight to treasuries and therefore a decline in treasury rates. So for treasury rates to move in the opposite direction, that was very troubling for people that were witnessing that, because it suggested that in this instance, we were not considered a safe haven during this panic. Sort of at the same time, you had a dollar weakening further. The dollars had an interesting pattern. So Trump wins the election. From then until the inauguration, the dollar actually strengthened quite a bit. Since his inauguration, the dollar has steadily weakened. It's now lower than it was on election day. And for the dollar, and I'll say this also, when tariffs, economic theory suggests, should cause a strengthening of the dollar. So for the dollar to weaken with the tariffs instead, that was another sort of troubling sign of what was being interpreted around the world. Scott Bessent, our Treasury Secretary, was able to accurately understand these two shots across our bow. I think he's a main architect of the April 9th announced pause. And essentially, I think it's well understood now that the scare part of this needs to be behind us. Going forward, we need to negotiate our trade deals and then be able to move forward. And as that occurs, the market will move forward as well. And I think the big question that can't be answered at this time is, what does this look like from an economic standpoint? Could this be something that causes a recession? I think we're going to know the answer to that probably in the next 90 days, as all of the rest of this sort of plays out. There's a silver lining to the weak dollar. The big negative, I guess, is the fact that it's inflationary. What we're importing costs more now, but it's also the case that for multinational companies in the S&P 500 case, 40% of their revenue comes from international operations. So as all of those earnings are translated back into a weaker U.S. dollar, that actually is going to boost corporate earnings and therefore benefit stock valuation. So there is a very important for us as stock investors silver lining to what's going on right now. And then the last thing that I'll mention is in late 2022, we launched our first ETF. BRNY is the ticker of it. We did that so that we could take our best performing strategy that was also our least tax efficient strategy and make it available to taxable assets. It's been a very successful ETF since its launch. We're going to launch a second ETF later this year, fourth quarter of this year. Your advisor will share more specifics as we go through time. But there's two big opportunities to understand. We're kind of just as a placeholder calling the second one BRNY2. We don't have an official ticker for it yet. But there is an opportunity to convert taxable stock assets into the ETF on a tax-free basis. It's called a 351 exchange. It's used in lots of different places, but it can be used to convert stocks into ETFs. And basically, you're just going to get a like kind return of value on the ETF side, but you get all of your low basis stocks loaded into this ETF. And then once it's inside the ETF wrapper, there should never be a capital gains that ever occurs again. So this is something, you know, a decade, 2 decades, three, until they change the tax law, that, you know, capital gains will no longer occur for the assets that are inside this ETF. We're very excited about this opportunity. And as I mentioned, we'll share more about this as as we approach the fourth quarter. So with that, I'll turn it over to Beechel. Thank you for filling in for Adam today.
Thanks, Lowell. So as part of my presentation, there are really three topics I want to cover. As we normally do, look at just different asset class returns in the first quarter of this year itself. Also, what looked a little bit different in that. The second is how quickly things have changed and staying focused on the long term. And the third thing I want to talk about is the markets and how they react to panic themselves. So when we take a look at the first quarter review, at first glance, this slide looks very similar to other slides we've looked at. Lots of green, little bit of red, nothing out of the ordinary. But when we take a closer look, what we see here is that the US stock market was the laggard in terms of the asset class, right? Down 4.7%. It's been quite some time since we've seen this, especially compared to their counterparts of looking at international developed markets and international emerging. I think we have a home bias of always just saying that the US market always does better. But this is a great example of why diversification does matter in times, and it happens right when you least expect it itself. Some people have asked, like, what caused this? One thing on the US side, we take a look back. We've had 2 solid years of stock market returns. A lot of those returns we've talked about in the past have come from a high concentration of stocks themselves. So perhaps this was just a broadening of the market itself and coming back to a fundamental basis of, you know, where's their fair value? PEs were creeping up to their higher end in the US, where they looked very attractive in the international market. And we were starting to see that in Q1 of this year. When we move over to the bond market, also very surprisingly, was off to a great start. People have asked, you know, why and how was this possible? So we finally got to a point where we felt comfortable where rates have come from an artificial balance of 0 to a normal rate. And then from there, many people were expecting a slow, steady decline in rates. And as a quick reminder, just the inverse relationship to the way bonds and interest rates work. When bond yields go down, the price of bonds themselves go up, and vice versa. So we were starting to see bond yields come down a little bit. So we saw some price appreciation in bonds for such a strong quarterly performance itself. So that was just like a look back in Q1, right? When you look at those 30 days, but then people are saying, I'm not quite feeling that. What happened? Right. So then from there, as Lowell mentioned, April 2nd happened, right? Liberation Day. That was a day that actually my colleague Andy here and Adam Newman had recorded a webinar kind of just talking through the impacts of tariffs, the impacts that they have on markets and portfolio strategies themselves. So if you haven't had a chance to see that video, please log into our website, berniewealth.com. If you go to the resource section and click on blogs, you can catch a recording of that presentation itself. For those of you that actually saw the video, thank you for all the positive comments, and continue to keep sharing that with anyone who is concerned about tariffs and would just like a quick debrief on how they should be thinking about the headlines that seem to be really, really scary. But I would say the presentation that Andy and Adam did was really helpful in breaking it down to simple terms. So with that, though, then there was a quick turnaround in the market. You know, everything started to go down. So the gains that we saw in different asset classes, they'd given those back up. The US market continued to go down. It felt like scary times, right? Like we saw nothing but negative headlines that the markets could just continue to keep going down. In fact, the 4-day period ending April 8th, the markets were down 12.1%. This is the 12th time in history that the market has gone down that fast, that quickly. Other times that this has happened was during the stock market crash of 1987, the great financial crisis, and COVID. With COVID being kind of our most recent memory, what I would say is that for most of us, we were trying to figure out how and when are we going to go to work. The global economy had come to a standstill. And if you had kids, like in the Patel household, you had 4 kids trying to figure out how to do remote learning, right? It felt like we were never going to recover from this. But guess what? If you fast forward through time, things do recover. Next slide, please. So if you take a longer term view of, you know, how does the stock market do even after times of panic, right? We tend to be able to recover quite nicely. What's interesting about this slide is of all the data points, there's only one that's in the red, right? And that's looking at the 5-year return in the US bond market. And that goes back to, as I was mentioning, when rates were at artificially low levels and the Fed was aggressively raising rates, that's calculating to that 5-year window. But outside of that, you tend to see a lot of green on this chart. Then the other green numbers, like why are they so important? What do they mean? And I'm going to kind of go backwards here and take a look at in time. If you look at the 10, 15, and 20-year number of the US stock market, solid double-digit returns, right? I think a lot of people will say, what do you think the stock market's going to do? They kind of reflect on just what the US stock market's going to do over a long period of time. And when you compare that to how they compare to international markets, primarily during that time frame, almost a 2-to-1, the US outpaced international markets. And I think that's why a lot of people have the bias of saying US is where I want to invest. But our team was talking earlier this week, and we were really diving into like market performance here over the 1 and 5-year period. And what's really interesting is international investing is very quietly closing the gap. Again, strengthening the conversation, all right? If I'm building a new portfolio today, what should it look like? And should it look different than it did 10 or 20 years ago? 10 or 20 years ago, many of our clients had an all US stock portfolio. We were in the right place at the right time. If we were building a new portfolio today, I would say it should look a little bit more different, and it should be a little bit more diversified.
Yeah, and Vijay, one point I want to make here with this slide is, obviously what we went through in the last few weeks, it's distressing, it's anxiety producing, right? It's easy to feel scared. And a really good strategy when you're feeling those things is simply to time travel, right? Think about how are you going to feel 1 year from now, 5 years from now, 10 years from now. Look back, how did you feel in March of 2020, right? Compared to how you feel now, So try to put yourselves in the shoes of looking forward to where you will be, and think back, like when I look back at this time frame, what's it going to feel like then? And I think that can maybe be a powerful thought exercise when we're feeling that level of distress.
Sure. And as part of being an investor, we have to be able to accept volatility, right? So one way in the marketplace that a lot of people talk about volatility is referred to the VIX index. When relatively calm, the VIX index is somewhere between 15 and 20. And then when we have these events that are happening, especially negative events, we tend to see a spike in the VIX. The VIX trading above over 40. What does that mean? And actually, what I wanted to highlight here is that prior to the announcement of the tariffs, the VIX index was very quietly sitting right around 20. Kind of a calm market is what we were experiencing, and normal volatility. And over a 4-day window, it went from 20 to 50, the third biggest increase in that time frame that we've ever experienced in the volatility index. So when that happens, that's, again, the price that an investor has to pay to capture those excess returns over time. The other thing I would kind of point out, next slide, in terms of the VIX index itself. So I mentioned that, it's at heightened levels right now. For this month itself, it is traded above 30 all but 2 days. So we're still at heightened levels. But this is when people start to ask the question, like, maybe I should just scrap my plan today, wait for things to calm down, and see what happens. To what Andy was talking about, if you zoom out a little bit, historically, what we've seen when the VIX index is at these levels, it actually produces the best returns looking forward. This current slide shows like a forward 6-month return expected when the VIX level is above 30. We can see this is the best time to kind of stay invested in the market itself. Next slide real quick. So with volatility, then we can expect ups and downs in the market, right? So here what we're taking a look at are the 25 best days in the stock market, with also the 25 worst days. And as you can see, the 25 best days tend to shadow the worst days. They come in a cluster, and no one can tell exactly when that's going to happen. This last month is a great example of this. Lowell had to kind of mention that as soon as we had the news of the tariffs being put on hold for 90 days, we saw, the biggest, I'd say we witnessed history, really. The S&P 500 was up 9.5% in an afternoon. We were all sitting in a meeting and we couldn't believe what was happening. And the Nasdaq itself was up 12.6%, right? So just to show, just 24 hours earlier to that, we felt like the sky was falling, and then all of a sudden we had a recovery. So the importance of kind of being rewarded as a long-term investor. here what we're taking a look at is market timing. So we get the question a lot, like, when there's volatility, should we just sit this out for a little while, wait for, the air to clear, we get the yellow or green light to get back into the stock market, we'll get back in. And we would say here at the Bernie Company, with our 5 decades of investment experience, we'd say we don't have a crystal ball. The crystal ball always looks a little cloudy. We'd rather take the approach of being fully invested at all times and being invested in a portfolio that is appropriate for you in terms of your risk tolerance and time horizon. So going back to the best and worst days of the market themselves, right? So what we're looking at here is that 7 of the best days have occurred over a 2-week window in the last 10 years. It's amazing, like, how quickly things can kind of turn around. And I think a lot of people will talk about, well, look at the percentage difference. If I just missed the 10 days versus if I fully stayed invested, 10.4 versus 6.1, that's not all that bad. But I think more importantly is if you look at your portfolio value, that's a difference of your portfolio value being double in value, right? So the importance of having the right strategy in place that you can weather both the good times and bad times in the market itself. So the moral of the story here is, I'd say, if you're nervous today, you should kind of take a look at your overall portfolio, make adjustments so that it allows you the ability to stay invested during times of panic itself. So what are our clients doing? Over the last couple of weeks, I've fielded a lot of these questions, especially from family and friends, like, hey, how are you at work? Like, what's it like? You must be feeling all these panic calls. And really, I'm not feeling panic calls. What I'm fielding are clients just want to know what's going on. But more importantly, what we're starting to see is that clients will say, I have extra cash, or, I was taking advantage of money market accounts that were paying 5%. They're no longer paying 5%. And I see the writing on the wall that it's going to go down to 3 or 2. And we've been reallocating that to a strategy that's appropriate for them. So I think a lot of people have been stepping away from the sidelines and trying to take advantage of when the market, quote unquote, is on sale. The second thing I would kind of highlight, again, with 5 years of investment management experience, if you're nervous about the market, please reach out to one of our team members. We'd be more than happy to talk to you about our wealth management services and creating a customized financial plan for you. And lastly, I'd leave you with that in times of stress, we tend to talk to family and friends, right? So if this is coming up in conversation if you're nervous, then please make an introduction. We'd be more than happy to help anybody that you know.
Bija, real quick, one point on that. What is the best way for someone to make an introduction?
Oh, that's a good question, Andy. Lots of times I get this from people that say, I gave out your name and number. And typically they give out my name and number because they're talking to somebody that they care about and they think that we can offer something of value to them. In order for them to get the help that they're looking for, what we found most effective is that if we make a 3-way introduction, and that can be done in the form of a quick conference call or a 3-way email, we're more than happy to help. And this way that your friends and family will get the help that they're looking for.
Yeah, that's perfect.
So with that, I'm going to turn it over to Andy. He's going to kind of go through our core equity strategy and give you an update there.
Yeah, definitely. So thanks, Bijal, for the update on just kind of the general market and the various asset classes. I think the next part of this is the question is, what is Bernie doing, right? Totally fair question. I'll distinguish between the two services. So for one, if you are a Bernie Wealth client and you have an asset allocation strategy, you take advantage of our financial planning work, your portfolio is probably held up pretty well, depending on the risk level of your portfolio, right? If you're in something of a more moderate risk tolerance, you've in a lot of ways been able to sit out the chaos and the craziness of the market. You do have some exposure there, but there's other pieces of the portfolio, fixed income, alternative investments, things like that, that are pulling their weight in terms of protecting the portfolio as well. So, if that's your camp, you've been treading water pretty well. Everyone, regardless if you take, financial planning or our investment management services, you get access to our U.S. equity portfolio. And there's, I think, some really interesting things happening there. So first thing we always like to talk about is how did size and style do, right? That's the core piece of our strategy. Whether you're in the master or our size and style responsive strategy, there's going to be some cycling as far as this goes in your portfolio. And really, I think there's 2 storylines here that I want to highlight. The first one is we've been in this market where mega cap growth, Mag 7, those types of companies have really dominated, right? These are just massive companies producing outstanding products, producing outstanding earnings and profitability, and the market has rewarded them over that time frame. So if you've invested in the Magnificent Seven, you've done quite well. In fact, if we look back at approximately a year, normally we run these numbers through the end of the quarter, but just given the market volatility, we decided to run it through Friday's close here instead. So it's a little bit longer than a year, but basically looking back at the past year, large growth is actually the only segment of the market that made money on a rolling 12-month basis. So they have done well. Interestingly, during the most recent time frame, so this quarter and into April, it's these stocks that have actually struggled. They've given back gains. We can think back to 2023 where a flight to safety was a flight to Magnificent Seven. Not so much this time. And what we've seen recently is large value stocks have actually begun to hold up better than the rest of the market, right? So I think some of that is tariff related, more domestic dividend paying stocks maybe are less impacted by the prospect of tariffs. The mega cap stocks have a lot of exposure to places like China where there's a lot of tariff negotiation and uncertainty going on right now. So in a lot of ways it makes sense, but this is a trend that we're following. The second trend, though, is small and mid caps continue to really struggle. So we've seen short 1-month rallies punctuate the larger pro large cap trend that we've been in recently. And unfortunately, we thought back in November we were seeing some evidence of small and mid cap momentum. And once again, it proved to be fleeting and fizzled out. And especially during this period of market volatility, small and mid cap stocks have really taken it on the chin. One way, I think the best way for us to visualize the impact of size and style cycling is to look at this chart. So again, I call it the wave chart. When we see blue, small caps are in favor. When we see gold, large caps are in favor. And what we can see is these are pretty long-term trends that take place. And so recently, it looked like we might be getting into a pro small cap rally. Especially as we approached the end of 2023 and got into 2024, but the pendulum swing the other way and large cap is firmly in favor here. So it's certainly the case that right now we are entrenched in a pro large cap market phase. And despite those little 1-month counter rallies, it doesn't seem like that's budging. Where we do think we see evidence of budging is when we look at style. So again, same chart, just we're looking at value versus growth. So value is in favor when you see blue, growth is in favor when you see gold. And what we've seen is we've been in a pro-growth market for about 20 or so months. And that's an important number because when we look at the average length of a style cycle, it's actually much shorter than it is with size. So we expect a style cycle to last anywhere from 18 to 30 months. And kind of right on time, back in November, we began to see pro value momentum begin to pick up, and that has really accelerated. So if we look back at the past 1-year time frame, there really has been no difference between value and growth. Neither style of investing has really been in favor. But if you look at the direction of where things are heading, it seems likely we're going to be heading into a pro value phase. And so I want to share some of the shifts that we've been doing in recent months to prepare for this. So back in November, as I mentioned, that's when we saw the first evidence of pro value momentum begin to take place. And as a result of that, we shifted our high level growth targets from 70% to 60%. So we moved further towards value. We would love to invest in small caps. I'll tell you that the academic literature supports doing so. But unfortunately, we saw that the November momentum in small caps fizzled out. And by the time February rolled around, we decided to shift our portfolios even further towards large caps from where we were previously. So our current large cap target is 80%. That might sound like a lot. And I think historically it is. If you look at, the way that small and large caps look historically, large cap stocks make up about 75% of the market cap of the US stock market historically, right? That's a long-term average. Today, that number is 90%, right? So there's a lot of concentration at the top. There's big asset managers like Vanguard and Goldman Sachs that are raising alarm bells just because of that concentration, but the momentum still supports it. So we're going to keep that large cap 80-20 tilt on, I think, for now until we see evidence of small and mid caps. Eventually, there's probably a lot of pent-up demand and that trade could work, but valuations are a poor timing indicator, and we're going to let momentum kind of drive the bus in the meantime. And then in March, so this is what just happened, kind of in response to the tariff news, we shifted even further towards value. So in November, we started moving from a growth lean a little bit closer to value. Now we're completely 50-50. You'll see us make these sort of measured stepwise approaches to shifts. It's rare that you're going to see us just swing the pendulum exactly completely the other direction. But my expectation, assuming that we continue to see this pro value momentum in the market, my expectation is that you're going to see further value shifts as we get further into the year.
And Andy, before you leave that slide, let me just comment briefly that um, our stock selection part of the process is more effective with the mid caps and the small caps than it is with large caps. So even if we're a little bit wrong-footed in terms of what our ideal concentration of large to small and mid should be, it's helpful that we have this ability to compensate on the small cap side. So we have two reasons to favor that. There's the academic long-term evidence of the excess return, but there's also just the knowledge that we do better with those kinds of companies.
Well, it's a good segue into stock selection, Lowell. And so, we oftentimes will focus on size and style because between the market factor, size, and style, that accounts for about 90% of stock market returns. But stock selection is an important piece of what we do. And what we know from building stock selection models through the years is that our process tends to be somewhat protective during downturns. So we're going to always remain 100% invested in stocks, which means when the market sells off, you're going to be exposed to that with your US equity allocations. But our process does tend to lead us into higher quality stocks with higher profitability that sometimes weather storms a little bit better than the average stock does. And that's what we've seen. So I've got this data through the end of March. So this is not inclusive of all the volatility in April, but it sort of tells the story where you can see the blue bars here are the stocks that our model says are viable. The gold bars are what it says we should avoid, right? And there's a pretty big delta, about 12% between those two. The stocks through the end of March anyways, that were viable kind of were able to hold their ground even while the general market sold off over that time frame. I will point out, though, that in practice, we combine our stock selection rating that tells us what to buy with a kind of an AI-powered, big data-focused revenue surprise signal that's just aiming to predict when a company is going to surprise on revenue, positively or negative, when they report on earnings. And so we really use that model to tell us when to buy something. And I think it's generally good practice to buy, to focus on solid, undervalued companies that look like they're poised to positively surprise on revenue. I think that's just a good process to buy that combination of stocks. But that revenue surprise portion of this does tend to lead us into a little bit more momentum. And this year has been marked by sort of an anti-momentum trend. And so that's drawn our stock selection effectiveness down just a little bit. It's still effective in aggregate, the way that we actually run this in production, but that revenue surprise thing has maybe hampered a little bit of the protective element. It's still there, but I wanted to highlight that. So this is kind of in the aggregate across all the stocks that we buy. I did want to share how this interaction looks. So if we just isolate our size and style responsive strategy in March and look at a return attribution analysis over that time frame, we can see that the market was hugely negative in terms of contributing to returns for our strategy. And we're going to feel that. We're going to be fully exposed to the market. No surprises there. Size and style actually wasn't that important. Large value held up relatively better, but still basically all size and style segments were down. So size and style did harm us a little bit, in part because we have got a little bit more small cap allocation than the general market does, but it wasn't a huge driver. You can see here that stock selection was a positive contributor during this month. So we were able to significantly add value through stock selection while the market was falling. And this is sort of the trend that I was speaking to earlier that we would expect to see in falling markets. We're still going to be negative, when the market's down, but maybe it won't be quite as bad as the market as a whole. And one thing I did want to point out, so if you've been on these webinars in 2020 or 2022, you've probably heard us talk about the recovery element of our stock selection model. And I've said this before, but it's sort of like in a perverse way, when we see a big market drawdown, like a bear market, we almost get a little bit excited because we know we have the opportunity to turn on our recovery model. So what we do here is, instead of looking back at past normal stock markets, we look back at past recoveries. And if you look at stock market, big bear markets, market crashes, most of them do tend to be pretty V-shaped and very predictable. So the types of stocks that sell off the most oftentimes bounce back the most as well. And so what we found is you can find high quality companies that were just oversold, kind of caught up in the animal spirits of the market. And then those are awesome opportunities when the time is right. So I'm not saying that we're necessarily going to be able to turn on this model just yet. I'm not sure that this downturn has been long enough or severe enough, but if it does get worse, this is going to be an area where we're going to be offensive. So our investment committee is evaluating whether or not we can turn this model on. I just wanted to bring it to everyone's attention. One final point here, not on the slide, is whenever we see market volatility, it opens up the opportunity for tax loss harvesting. So we came into this year, 2023, great year for stocks. 2024, great year for stocks. It's amazing for client returns. It also makes it challenging to manage taxable assets, right? So the expectation coming into the year was that clients that are in our separate accounts that use individual stocks, not any of our ETFs, would be generating capital gains. This period in the market does give us the opportunity to do some tax loss harvesting and try to help. The last time we saw such a sharp downturn, this one isn't quite as bad, but was 2020. And in 2020, many of our clients who have taxable accounts actually had realized losses on the year and then double-digit returns to show for it, right? So they made money, had realized losses, have your cake and eat it too. So we're going to do that now as best we can. And that's kind of a silver lining of market downturns. And so with that, we did want to get to the Q&A, and I appreciate everyone who asked questions. This was a really interesting Q&A because we solicited your questions sort of in the most emotional time of the drawdown, and I think that a lot of the questions here reflect that. But at the same time, we did not want to pull any punches, and we wanted to make sure that we, if you guys are feeling anxious about the market, and that's going to come through in the questions, we want to make sure that we address that head on, and we're not going to hide from anything at all. So the first question I wanted to get to is maybe the hardest question that we had here, and it's, why did you not see this coming? And it's a fair question, right? Because the tariffs were in a lot of ways telegraphed, right? Like, we knew April 2nd was so-called Liberation Day. And I'll briefly say that there were actually a lot of stock market participants who were looking at it as a positive thing, because they were thinking, okay, stock markets hate uncertainty. This is going to give us some level of certainty. And that's going to allow stocks maybe to realize that things were okay. What actually ended up happening was the tariffs were much worse and much more harsh than expected, and the stock market had to aggressively reprice that in. What I will say, though, just irrespective of the reasons for it, we are always going to remain 100% allocated towards stocks, because, quite frankly, we don't know. It's impossible to predict in the short term what the stock market's going to do. We've seen times where the stock market doesn't make any sense at all. Some examples of that is, March of 2020, March 23rd, 2020 was the bottom of the COVID market. And there were, closures, many, many months, if not years of closures to come. There were millions of deaths to come. And it seemed like it didn't make any sense. Why is the stock market rallying even though the worst is yet to come, right? So it's oftentimes, I would in fact expect the stock market not to make sense, because it is forward looking. So we don't know, when the next market crash is going to happen. We do know that corrections happen about once a year. And this certainly does qualify as a correction. And we know that bear markets happen about once every 5 years. So we've already had two. In the past 5 years, having a third one would be a little bit unusual. But as a matter of policy, we're always going to stay 100% invested. I will say the levers that we do like, because 100% equity allocation is not appropriate for everyone. So we do offer financial planning as well. And as part of that, asset allocation portfolios are there to help turn down the risk dial for client investments where it makes sense. So our preference is stay 100% invested in stocks. If that type of an allocation is too risky, I'd rather round out a portfolio with international stocks and bonds and alternatives that are really diversifying to help turn down the risk dial so things aren't as bad in practice. Let's see, Joel and Lowell, do you have any other points to make in response to this question?
Yeah, let me add a little bit to that. So I would say to a degree, we did see this coming in the sense that Trump has a certain approach that is consistent through time, and we've been expecting something like this, and exactly what it was going to be, there was no way to tell that in advance. But the fact that Trump was going to sort of be a disruptive president, that was kind of expected. Um, you know, uh, and having some constraints, from going too far, I think is also part of like the experience. And as I mentioned before, we had a good example of that during that 1 week period in early April, where they can right the ship if they overstep what they were intending to do. So but the problem is, and we shared this in previous presentations, our expectation over the balance of Trump's presidency is that the market's going to rise as it normally does. We see that consistently through time. We see that with his first term. So we need to be exposed to the market, and we need to expect there to be volatility that might be heightened because of who he is and how he operates. So to some degree, I think we actually did anticipate at least a part of this.
All right. We'll leave that one there. And we're going to start with the theme of volatility. I like to break the questions down that we receive in themes. So we'll start there, and then we'll get to some other areas, although they are usually related. So to the point, we all knew tariffs were coming, right? We just covered that. So what's the next step? What are we going to do to manage stocks that are maybe at risk to those tariffs and exposed to those tariffs? And then, how should we think about taking advantage of other markets like the European market? Lowell, why don't you lead us off here with thoughts on this question?
Yeah, so I think there's a big it depends on sort of answering this question. So if the tariffs look like something around the 10% tariff that's in place right now, then I don't think this is going to be the tailwind that's going to prevent us from being successful, ahead. If this turns into something different than that, then yeah, it could. So that, and again, today we don't know what the answer is. In 90 days, we're going to hopefully have a clearer understanding of what this looks like. I'll tell you a little bit of like what's behind all of this. If you look at U.S. manufacturing jobs as a percent of total employment, we had this peak that occurred in the 1940s, where we had somewhere over 30% of all employment was factory jobs, was manufacturing, and there has been this steady decline over decade after decade until a decade ago. So, into like the 2010 period, where manufacturing as a percent of total employment was less than 10%, and it's been very stable since then. So, a modest tariff that maybe bumps us back on the other side of 10% instead of under 10%. That's not necessarily a bad outcome for us as a nation, because there's times where the world disrupts and it's nice that we can make our own stuff. But it's there's just a lot of uncertainty that still remains about what is going to happen specifically with tariffs ahead. And it's as we've said, there's diversifying assets. That's one of the risk measures that can be taken. And then there's also this opportunity when things get really out of hand that we can go on the offense, as Andy talked about, and deploy recovery score. We've had our best relative return periods in the last, I don't know, decade have been during those markets. So there is a very bright side to this if things actually do get worse instead of getting better from here.
And one point I want to make, this is a point that Adam and I made in our tariff reaction webinar that we did, back in early April, right after the news was announced, is that this is basically a strategy that Trump has employed before, right? Where there's going to be some sort of crisis that's created, and that crisis is going to be used for leverage. So maybe it's shutting down the government to fund a wall. Maybe it's threatening to pull out of NAFTA to get additional concessions from Canada and Mexico, right? We've seen this kind of three-step process happen before, right? So this crisis is, I'm going to slap tariffs on the entire world. Step two is, use that as leverage to negotiate new trade deals. I'm not going to, pass any value judgment on any of that other than that, this is the strategy. And then the third step is announce some sort of a negotiation, some sort of a win. And that does seem to be what's happening. In fact, that's why the market rallied so much on April 9th when we had that, just about a 10% update for the S&P 500. And it's because reciprocal tariffs were paused for 90 days. And that was, the market kind of getting confirmation that the tariffs that were announced aren't likely to be the tariffs that are actually put in place, right? I think we know that if the tariffs that were announced are put in place, it's pretty easy for any economist to predict that a recession is about to happen. And so seeing that there is maybe a plan and that there's negotiations that are actively happening was comforting for the market, and probably part of the reason why we've seen a lot of the volatility die down. One thing I did also want to point out in response to this question is, though, we have seen, and this is what Bijal pointed out earlier in his presentation, we have seen international stocks be diversifying during this episode. We're seeing developed markets, especially in Europe. Some of the best performing countries in the world right now are coming from Europe, places like Germany, and even emerging markets have been able to make some money or at least outperform the U.S. So getting some of that international exposure, that is something that's part of our asset allocation portfolios that our financial planning clients use. And maybe that's going to be more diversifying than it has been over the last 15 or 20 years. Anything to add to that, Bijal?
I totally agree. Like it comes back down to just total diversification, right? When people hear that, sometimes they just think that they're going to take on less risk and not make as much in terms of returns, but you could still be an aggressive investor and be globally diversified.
Absolutely. So there are a couple questions here where the theme was, how defensive are we going to get given the uncertainty in the market, right? So we had this question here. We had another question about how is the equity strategy being modified to minimize damage and maybe maximize the gain, right? So Bijal, you presented data on this, about why getting defensive maybe feels good in the moment, right? It's kind of how we're biologically tuned. When we see damage, we want to do something or when we're feeling pain, right, we want to do something to limit the pain. Right. But in actuality, that actually, that might lead to worse outcomes. So first question, should we be defensive when markets sell off?
So I take that in two different ways. One is that if you've got the right strategy in place and the right risk profile, then I would say continue to do what you're doing, right? But times like this, I think really makes us have an honest conversation with ourselves. Can I accept the amount of risk that I'm currently taking, right? So there are definitely some investors out there that are probably taking on more risk than they should. They see these big drawdowns, and that's when they feel like they need to make a move. So I would say something like that is, have a conversation with one of our advisors. We could really take a look at, what's your appetite to risk? What's the amount of risk that your portfolio actually needs to take on to meet some of your long-term goals? And that will then determine, do you have the right allocation in place? And that allocation will allow you to then be defensive and ride through these times of volatility.
Absolutely. And I think that the chart that showed that the best days in the market occur around the same time as the worst days in the market is why it actually is a cost to get defensive when markets sell off, right? We've already been through the bad days. You might as well stick around for the good days.
Right.
A related question to this that I think is what I was trying to get at a little bit earlier when you were talking about your slides with my time travel strategy. But I think this is a great question. Some of this stuff we've already hashed out already. But I think the question I want us to react to here is, when should I begin to worry? Lowell, how would you answer that question?
You should worry every day, is the honest answer. The market is always poised for a sudden sell-off. Like some outside event could occur at any moment that gives us you know, an uncomfortable market knock. I can't even count how many times I've experienced that over the years here. So psychologically, preparing yourself for that eventuality, because it's not like maybe it's going to happen. It's definitely going to happen. We just don't know exactly when and how deep it's going to be. But the other thing that's very comforting is that it's going to recover unless we do something that really economically destroys us. The markets are very resilient. They take this sort of, if you think about the value of a company that's operating, you know, so end of March and then operating today. Forget the tariff impact potentially for a moment. The real value of that company hasn't really changed. It hasn't declined 10% or 15% in a matter of a couple of weeks. Similarly, if you get a big market move higher, that's not really a reflection of underlying value. That's a reflection of our emotional component that's at work inside the stock market. So as long as there's good fundamentals that are underlying the stocks that make up our portfolios, then there's nothing to worry about with volatility. So, but you got to take the long view, and you've got to take you got to accept the fact that this volatility is just a fact of life. And I can spin this positively by saying stock investors would not get the returns they get if not for this volatility. So I can make a case that volatility is actually, a great thing because we're getting paid for that. We're being paid for going through periods just like now. And if it didn't occur, our payout would probably be half what it otherwise would be. So just stick it out. This has been the advice of the Bernie Company forever is anticipate that these are going to happen and then just stick it out when they do.
I'd add one thing to that, Lowell. In order to be able to stick it out, I think what a lot of clients need to do is one, have a cash reserve that allows them to not have to rely on their portfolio and draw down on the darkest days. And then as part of that is just also comes back to asset allocation, right? So if you have all of your money in stock markets, then you're going to be worried. But if you've got it diversified based on your risk profile, I think that gives you a little bit of security and that you're not worrying and having to pull at the wrong moments in time.
Absolutely. And one element to this that's not financial at all is that when markets sell off like that, it's completely normal to feel anxious, to feel scared. Sometimes we view negative emotions as something to put in a box and to shove away and try to avoid feeling. But when markets do sell off, it's very real to see the dollar value in your portfolio fall, and that's going to be scary. Totally understand that. And I think expecting that emotional reaction is going to happen goes a long ways, and then finding strategies to mitigate that, right? Because what you want to avoid letting these negative emotions become ruminations, and all of a sudden it's all you can think about and you're losing sleep. So, I play in an adult flag football league in my free time on the weekends, and I was thinking to myself as I was coming back last Sunday, I was like, I didn't think at all about the stock market. I just went out there, lived my life, and had fun, and that helped from an emotional, psychological standpoint. So sometimes whatever you do, just to mitigate stress and anxiety in your life in general, those strategies also apply to the stock market. So one final question here, where volatility is the theme, and then we'll pivot and talk about some other things. I think this is a great question because this client is acknowledging that they're patient and they understand that market fluctuations happen. And the question is there anything we should be doing to protect our investments? I would turn this and I would say probably the thing you should be doing is not focusing on protecting your investments, but focusing on going on the offensive, right? If you've got cash on the sidelines, go ahead and put that to work, right? We see that the bad days and the best days happen next to each other, right? April 9th was a great example of that. There might be more of those big up days, and you can take advantage of depressed prices. So I think, thinking we're psychologically, we're set to feel losses more than we enjoy gains, and that's going to really color the way that we feel when stock markets sell off. That's why the theme for so many of these questions have been protection, protection, protection. I would turn that and say, go on the offensive. If you want to do something, that's probably going to pay off better in the long run, even if you don't take the bottom. And you probably won't. That's still going to pay off in the long term. All right, so let me move on here then. We'll take the volatility theme out. And I wanted to go in a completely different direction here, because there was a question that seemed maybe totally unrelated to what was happening in the market. And the question was, what are some tax strategies to take advantage of in the next few years? And I think that this is a really open-ended question that can go a lot of different directions. Bijal, do you have any ideas along these lines?
Yeah, so there are a couple of things. Like one, like you just mentioned, the open-ended question, I think we're all paying attention to, is there going to be an extension of the current tax laws, and how does that impact us directly? How does that impact small business owners? So there's a lot of unknown there. But what I would say, specific to any one person's tax situation, probably just talking to your own accountant. If you don't already have one, we've got a great service with Bernie Tax Advisors, reaching out to us and setting up a tax strategy, right? So this takes into consideration your specific circumstance, and then we can kind of go through and say, are there things that you haven't been doing that you should be taking advantage of, or the things that we should just bring to your attention itself? So I think reaching out to our team, Bernie Tax Advisors is the website. That'll give you an opportunity to schedule an appointment with us.
For those of you who maybe were living under a rock, tax day was yesterday, right? So now is actually a much better time to try to get a hold of Rhonda and the team over at Bernie Tax than it was in recent weeks. So if you want to ask questions about tax strategies, it's obviously going to be really personal to you. But if you want tax prep, tax planning, it is something we offer. Another thing we offer, Bijal, is
Hold on, Andy, before you leave that, let me make another BRNY2 plug as a tax strategy. Protecting your capital gains in an ETF is this was something that's actually been an opportunity for a long time, but that nobody realized was there. And it's really just been in the last few years that active investors have been putting their strategies inside an ETF wrapper. Prior to that, it was all a bunch of passive, like basically an index mutual fund became an index ETF. But being able to put an active, and especially like in our case, high turnover tax and efficient strategy inside that wrapper is a big time game changer. That's, I think, one of the big opportunities that will be there for all clients this year. We're gonna launch this thing later this year, and then this is maybe a little more than what a lot of people are going to be comfortable with. But for some of our clients, we have a 1-30-30 strategy where if we've got $1 million account, we buy $1.3 million of stocks long. In this case, it's the ETF and the capital gains protected structure of that, with 30% offsetting short. So your exposure on a net basis is the same thing as being 100% in the stock market. But it's 1-30-30 allows you to take advantage of the difference in return between your long positions and your short positions. And in rising markets, those short positions, as you close them out, they create capital losses. So we've got a number of clients that have been in our 1-30-30 strategy since our ETF conversion in 2022, and they've experienced like the perfect first 2 years, 2023, 2024, great performance, great growth in assets. And then, oh, by the way, at the end of the year, here's a bunch of tax losses that you can use to offset other income. So this is another thing to talk with your advisors about. But if you're considering this opportunity to convert taxable assets into our second ETF, you might also want to consider looking at this 1-30-30 opportunity as a further measure to lessen your tax burden.
Yeah, if you let's say you've got some sort of like a tax inefficient option strategy, right? That's kicking off income that you maybe want to help mitigate, or maybe you have a business that you're looking to sell. Maybe you've got real estate that you're looking to sell. Maybe your house has appreciated so much that you're going to owe capital gains taxes on that when it sells, right? If these are your situation, or even could be your situation, using this 1-30-30 strategy just to develop, really, it's like a tax asset that you can use in future years, could be hugely beneficial. So please reach out to your advisor to talk more about that if it's of interest. So one of the themes of this, whenever we hear about volatility, one of the things that I like to bring up is, we do investment management. We also do financial planning, right? So the answer isn't 100% US equities or 100% cash. There are steps in between that. So we got a couple of questions that I think really speak to the value of taking advantage of our financial planning services. So one, I'm 68. My retirement accounts have lost significant money in a short period of time. I'm feeling stressed because I want to retire at 70. Like, what should I do? What should I expect? Right. Another question here is, I'm 6 years away from retiring. And what's the best reaction to this volatility? What should I do? What kind of allocation should I have? So this is, we in the past, we've, full disclosure, we've had clients leave us who were very happy with our services, that we made them a lot of money through the years, where we were focusing on trying to grow their accounts as much as possible, but life changes. You're preparing for retirement. The same amount of risk that you were able to take when you were 30 or 40 may not be as appropriate when you're 50 and 60, right? So Bijal, I guess my question here for you is, when it comes to changing life circumstances, especially when it relates to as we approach retirement, how should people be thinking about changes to their investments, if at all?
Yeah, I think it's a great question. And I think most likely there are probably some changes that need to take place, right? So part of it is it's very customized to that particular client and their family. And what we'd like to do when we go through a financial planning process with our clients is really get a really good understanding of, as you're getting ready to transition into retirement, one thing that we know, clients have always been used to working really hard, making money, right? They've had money coming in, and now they've got this transition of, like, they have to live off their portfolio, right? So they're relying on the income from their portfolio to live off of. So I think doing a deep analysis of understanding what are the income requirements of your portfolio, and then working our way backwards of figuring out what's the right amount of risk moving forward. So potentially you might need to change your risk profile ever so slightly. In some cases, it might be an extreme, but I think just starting in advance, right? As opposed to you're already into retirement, then the market draws down. Now you're trying to make a defensive move, right? Versus offensive move is if you're looking into retirement, whether it's 2 years away or 5 years away, I think you're in a position of strength to being able to do that, and sitting down with us and doing a deep dive, and then allowing us to come up with a recommendation that will say, here's a portfolio that takes on a little bit less risk, but it's going to allow you to sleep well at night and enjoy your retirement.
Absolutely.
Let me touch on this too, Andy. I'll share a personal experience where when we rolled out planning as like a new service for our clients, I wanted to experience what our clients would experience. So my wife Mary and I actually went through the process just to sort of experience it. And when that was all said and done, and by the way, and I felt very proud of like the process that we had set up and how thorough it was. But at the end of the process, what I didn't anticipate is how much peace of mind my wife got from the process. Like in our dynamic, basically I've been tasked with handling the financial affairs. She does everything else. Not exactly the fairest of balance in our relationship. But that piece, and I never realized that she had worries that were there that could be addressed just by like having things laid out. And like in her case, here's what the next, let's say, she was 55 at the time that we went through it. Over the next 45 years, because all of our clients are going to live to be 100 years old. Over the next 45 years, this is what this looks like, as it plays out over time. It was very comforting to her, and that made me feel even better about the process. So I would suggest, if you haven't gone through that process, there's no cost to it. Every one of our clients should consider just going through that process to get some clarity on what this looks like, especially when you're in a transition, a couple of years away from retirement. And now, because the goal isn't to like invest to retirement, it's now the rest of your life investing. And there's a lot of big decisions and opportunities that are all part of that process that will be uncovered as you go through that.
Yeah, it's a great point, right? Basically, what this provides, we can talk about all the things that it provides as far as asset allocation goes, as far as investing and any of that, but really the service is providing peace of mind, especially to someone who maybe hasn't been as involved on the financial side as you might be. So certainly, if this is something that you're interested in, please reach out to your advisor. I think it does go a long ways. We're coming up to the end. There's just a few more questions that we have, some on the economy. We actually had a couple talking about bonds. So, are U.S. corporate bonds still a good investment, or are you now recommending, Europe, international, I guess, fixed income investments. Related to that, how has our outlook on interest rates changed? So, and how does that impact the outlook for bonds? So Beej, I'll let you kick off with this one. First, when we're thinking about fixed income, on one hand, tariffs have the possibility of being inflationary, right? And we don't know how the Fed's gonna react to that. But on the other hand, we went through a really painful time in bonds in 2022, and now we're reaping the benefits of that, where bonds are actually yielding significantly higher now than they were for much of the past 15 years. So how should people be thinking about bonds in today's climate?
Yeah, I think as part of again, diversified portfolio, bonds do play a role, right? And then within that, I think we can go deeper to say, is it what type of bonds, right? Are we looking at short-term versus long-term? What type of credit are we taking? And having the right balance between all of that to kind of counterbalance what you're doing in terms of the riskier part of your portfolio itself, right? So bonds should be a part of a diversified portfolio. I think our team does take a look at this in regards to through points in time, depending on what interest rates are doing. Are we going to be focused on the short end of the curve or the long end of the curve? Do we want to take on credit, or do we want to not take on credit risk, right? So we look at this as not just a question of should I own bonds or should I not own bonds, but we want to take a look at it as part of a well-diversified portfolio. How do they really interact with the other investments that we're putting in? I think, Andy, you'd kind of mentioned, right, like our portfolios that are diverse, it's not just about stocks and bonds, it's about stocks, bonds, and alternative investments. So there's a lot more that goes into it than a simple answer of, do I want to incorporate in corporate bonds into a portfolio itself? It's how are they going to interact with the rest of your portfolio?
Yeah, and I feel like I'm interjecting too often, sorry, but sort of on this topic, we've utilized private credit. So there's public markets that include corporate bonds, treasuries, all of those sorts of things, where you have a lot of these decisions to make. On the private credit side, these are typically companies that are not able really to go to market and take advantage of the public bonds, and for a variety of reasons. The banking community is not as accessible to them. So there's these companies that set up, and it's a lot of the biggest asset managers in the world that have private credit as one of the business models that they have, and they become the lender. But what's typically the case with them is they take the top of the seniority, so they're the first claim on assets should something bad occur. All of their rates are variable rates. They reset either quarterly or annually, so there's no duration risk, right? They can, if the interest rate environment changes, they can immediately see that change in what they're getting paid for their bonds. And then they have these specialists that when something does go bad, they actually can go in and work out, help salvage whatever they can from the company. A lot of these companies have private equity backers that are another source of funding should things go sideways. So there's a really strong case for private credit as a big part of your what would normally be your bond allocation. And if you'd like to learn more about that, this is something that's in all of our allocation models. All of our advisors are very well versed on this if you want to explore that further.
Great. Yeah, the way we think about that is in public markets, we're typically investing in treasuries, so we're avoiding credit risk. But as we saw in 2022, even if you've got treasuries with no credit risk, they still have interest rate risk, and they can fall in value if rates rise. Private credit proved to be hugely diversifying in that environment, just because it tends to be more floating rate in terms of the terms of the deals, and that helped hold up, like in 2022 when inflation was took hold of markets. We've got one more question here. And this one maybe is more of like a macro economy question. But I think we saw this with the moves in the 10-year, the moves with the dollar. The question presupposes that investors from around the world are losing confidence in the US, whether it's the market, the dollar, bonds. Lowell, I'll let you maybe take us out on this one. What does it all mean? And does it change our strategy at all?
Yeah, it's a good question, and these are kind of questions that I know a short while ago nobody even contemplated as possible questions for what we're going through right now. But as I mentioned in the intro, we saw a couple of pretty disturbing signs that this is actually something that's happening in the world in terms of reevaluating what our role is in the world, financial structure. Um, this is serious. The United States has to respond appropriately to this and not do more things to call into question, what our role should be. I don't think, the economists that we follow, none of them think any permanent damage has yet been done. And I think they all think that there's been, um, you know, the message has been received also at the same time. So those are the two important things. So for right now, we're standing pat, other than the fact that, we do broadly diversify and, by having some allocations outside of the US, that's not always a bad thing. I mean, that's always a good thing, actually, just in a diversity, sort of standpoint, but maybe especially timely right now. So we're going to monitor this. And obviously, if things change, we're going to be very proactive in terms of communicating our read on whatever those change things are.
Right. Just like we were proactive in responding to the Liberation Day tariffs. We gave people 3 hours notice that we were doing a webinar, and we had over 100 people register. Most of them showed up live. And so, we'll be just as proactive if anything does change in the future. I want to thank everyone who was on that webinar, who was on this webinar, who asked so many great questions. I know this has been an especially emotional time just with the stock market moves. And, getting these questions out, I think, goes a long ways to helping to deal with it, right? I think the message that, we've tried to communicate here in this webinar is that you're doing the right thing by staying pat. You're doing the right thing, by going on the offensive and trusting in your strategy. So we just wanted to appreciate everyone, each and every one of you who has joined us for any of these webinars, and we look forward to talking to you in the future. Thanks.